So, Netflix crashed 22%, from $510 a share to below $400 a share. And that's after it already saw a steep decline from an all-time high of $690 a share, which means it's now fallen 42%. Basically, it's sitting at its pre-COVID share price right now. What exactly happened with Netflix and why has it happened and what are my thoughts, my views on the company? Well, that's what we're going to talk about today. Now let's start off with what the actual news was. Why did we see this drop? Well, we got earnings reports and reports on Netflix's growth numbers for the last quarter. Now, these quarterly updates came through, and in short, they weren't very good, or at least they weren't as good as some people expected them to be. Analyst consensus among Wall Street was for 6.26 million new subscribers to be signed, but the company only signed 2.5 million new subscribers. On top of that, operating income from Netflix fell to $616 million for that quarter from $1.4 billion the prior quarter. In short, the company spent an extra $1 billion on their services, but they only made another $200 million in income. Now, Netflix was quick to put some caveats out there and try and explain this supposed poor performance, and they claimed most of it was due to a COVID overhang. Basically, that the remnants of the COVID pandemic are impacting the company and stopping it from performing as well as it should have. They also blamed their supposedly bad results on some tough economic conditions in some foreign markets in places like South America and with high inflation all over the world. Now, this is actually bad news for Netflix, let's not get it twisted. They came out with 2 new films, Don't Look Up and Red Notice, and they were 2 of Netflix's 3 most viewed films ever in history, and they were supposed to bring along millions of new subscribers, but they just didn't. Lots of analysts and investors are obviously worried about this being a new trend, of it being harder for Netflix to grow, and that's affecting how well they think it's going to do in the future, and as a result of that, its share price today. Now, to clarify everything, the actual numbers that Netflix posted are fine. They're not good, but they're not awful. Netflix is still growing, and they only actually missed their yearly targets by a very small fraction. That has then led a lot of people to wonder why the 20% drop, or 22% drop I think it actually was. And the reasoning behind this is that this represents a major shift. Missing targets doesn't just happen once, and underperformance for Netflix is expected to continue. We're not talking about one deal or one contract that was failed. We're talking about hundreds of millions of individual decisions made by consumers all congregating together to make this earnings report. If those hundreds of millions of people are feeling a certain way, it's likely that they're going to continue to feel that certain way in the future, and once a trend like this starts of slowing growth, it's really difficult to stop it. Now, why is this trend here? Well, there are a bunch of different reasons. One of them is that most people who want to have Netflix today already have it, especially in developed markets. The room for growth in subscriber numbers is limited mostly to higher prices in developed markets and developing countries which are worth less anyway. Basically, it's going to be harder and harder to get more subscribers from the US because everyone in the US who wants Netflix pretty much has it. So their growth from the US is going to be limited to raising prices, which consumers have just shown they aren't too receptive to. In developing countries, or just developed countries which aren't quite as saturated for Netflix, customers are just worth less than in America or Canada or Australia or other very wealthy countries, and so that's not great for Netflix either. If you are a company, in short, you'd rather have 1,000 customers from America than 1,000 customers from South Africa. It's just the simple truth. Now, this trend is actually quite clear. The most valuable country in the world for consumers is basically America, at least when we're talking about big countries and not places like Monaco. Then we have the other wealthy Western Anglospheric countries like Canada, Australia, and the UK. And then we have just as wealthy countries, but maybe countries where English speaking isn't quite as prevalent. And then the mid-tier countries, and then finally developing nations. And in short, you want customers from the first countries I mentioned, not the last ones. They're just worth more for your business. Now, on top of that, cost per acquisition for Netflix is rising loads. As I said earlier, they spent $1 billion more last quarter than the quarter before, and yet they only drove an additional $200 million in sales. Now, that is actually pretty bad news, especially if Netflix is already concentrating on lower value demographics, those countries I mentioned earlier. Basically, Netflix is starting to run out of room for growth, and that's one of the major reasons why it dipped by so much on its poor results. Another major reason why it dipped so much is that it was overpriced, and that's pretty much as simple as I can make it. The company had perfection priced into its value. Anything less than perfection then warrants a drop in perceived value, and we didn't see perfection the other day. At its peak, Netflix was priced with a higher PE than Microsoft, Apple, and Amazon, despite slower growth and fewer chances for growth and far weaker moats for Netflix compared to other companies like Apple. Their technology as well isn't actually that good. Their algorithm is crap, and they're losing the content war as well against their competitors with just deeper pockets. Something that ties into all this but isn't really directly related to their 22% drop the other day is the fact that Netflix is considered part of FANG. Supposedly the 5 biggest, most advanced, most dominant tech companies in the world and in America, but Netflix always just sat there and it really shouldn't have, and the fact that it was shows how deluded the market was. Now, another major problem with Netflix, and one of the reasons it's dropped, is that Netflix raised prices and analysts thought that subscriptions would be inelastic. Basically, they thought that people wouldn't cancel their Netflix subscriptions because the price went up by $1 or $2, but these analysts were basically wrong. People did cancel, and this limits the scope for price increases in the future, which is again bad news. Especially since we've already established that raising prices is one of the only real ways that's going to work long into the future for Netflix to grow revenues from these already saturated markets. Now, on top of all that, there is loads of competition in the sector right now, in streaming and in media in general. Netflix had years as the big dog, and now they're under attack by companies with deep pockets as well, like Roku, Disney, Apple, and Amazon. To make it all worse, content on Netflix is not getting much better, and people are starting to notice. Netflix just isn't really essential viewing like it used to be. The most popular TV show on at the moment, the one that everyone's talking about, is on HBO. It's called Euphoria or something. I don't know, I haven't watched it. I don't really watch much TV. But that's the thing that's getting loads of attention. It's not anything on Netflix, and that represents a major shift in the way culture works with streaming and with media in general. Netflix is just no longer dominating the market like it used to. Now, this stuff is all really well known, to be honest. Nothing I've said there is groundbreaking. Nothing I've said there is hugely controversial. You might disagree with how I've tied everything together, but you can't really disagree with any of the individual things I said then. What's my opinion on the company and on this whole situation? Well, Netflix's room for growth in its richest countries is too small. On top of that, breaking into new markets is just as difficult for Netflix as it is for their competitors. They also have pretty pathetic foreign language options, and that's going to make it even harder to continue to break into new markets where maybe not everyone speaks English, and it just means that they're going to struggle to dominate these new environments. Now, on top of all of that, macroeconomic factors are also very important. Netflix is a business. It exists in the world, and if the economy of the world suffers, then Netflix is probably going to suffer as well. If people are feeling poorer, very simply, they're going to spend less money, and Netflix may well be one of the first things that people stop spending that monthly subscription on. As of right now though, Netflix is cash flow free. They make plenty of money, and they don't need to raise capital to survive. So that is good news, and if there is a huge, massive recession, they probably aren't going to go bankrupt. But if they want to grow huge amounts and to compete with the likes of Apple and Disney, then they might need to raise capital at some point in the future, in which case a tightening monetary environment where bond yields are higher and interest rates are higher isn't good news anyway. Of course, we know that that monetary environment is coming. Interest rates are rising. They're probably going to start in March, but they're certainly not going to stop there. Bond yields as well have been rising as well. The 10-year Treasury is sitting at 1.76%, I think, right now. And so raising capital in general is just going to get more expensive. And that means that growth companies are going to take hits to their valuations. On top of all that, rising interest rates will probably mean that people have less money to spend as they have higher debt obligations. Very simply, if you get a mortgage today, it's going to be cheaper than if you get a mortgage in a year's time. That's going to be more money out of your pocket. Your car loan is probably going to get more expensive. Your credit card debt is probably going to get more expensive. People are just going to have to cut back on spending, and Netflix is no longer essential for a lot of people, so there's a good chance that their subscriptions might even fall in the future. In short, people are going to have less money to spend on leisure, and Netflix certainly is leisure. We've already seen the idea that people will cancel Netflix if they raise prices by too much, so it's not hard to get your head around the idea that if people have less cash as well, they might cancel it anyway. On a whole, Netflix had a 10-year head start in this market. They used it very well. They built up to being a dominant player in streaming. They basically created this market as a whole as well. But now there is just too much competition and there's nothing really to set Netflix apart. There are some rivals with deeper pockets. Apple, Amazon, and Disney are not small fish in this pond. Growth for Netflix is starting to wane as well, and it's only expected to slow further as we go into the future. On top of all that, even after this 20% drop, and even after the 45% drop from the company's all-time high, it's still priced expensively. The company still has a price to earnings ratio of 35 after this 20% dip. That's still very high. Very simply, why would I want to own Netflix at a PE of 35 when Apple trades at a PE of 29 and it's a better business in every sense of the word, and it even has exposure to the exact same industry through Apple TV? Investors are realizing this and prices are reacting to this. This is just very natural and it's not exactly a new trend either. Netflix has been declining drastically in price for 6 months now. This is just a quick acceleration of that decline. Now that's my ideas, that's what I think about the company, and that's obviously a little bit bearish. I'm not bearish about the company itself, but I am about its share price because the really important thing here is that price does matter. Now what about the bull case? Well, for that, this video by Joseph Carlson summarizes that quite well. He's a YouTuber, he does investing videos, they're actually really interesting. I agree with a lot of his takes, but I disagree with a fair amount of his takes as well, especially with his one on Netflix. Now, he owns a lot of Netflix. I don't know how much exactly, but it's a very hefty weighting in his portfolio, and he's obviously very bullish on the company. Now, if you want to hear him explain why in detail, then I'll link his video down below in the description. You can go check that out, but I'll briefly explain his viewpoint now. Basically, Netflix is still growing, so this news isn't actually bad. Prices have increased as well. Earnings per share was actually a beat, and a beat by quite a long margin. Netflix still has other countries to grow into as well, so there are new markets to tap. Now, my main problem with Joseph's arguments there is that really he's ignoring rising costs for slowing growth. He's ignoring anything to do with valuation or the price of the stock. He never once tried to actually justify its current or even its previous price. He pretty much just ignored competitors like Disney and Apple and Amazon Prime. He pretty much ignored macroeconomic conditions as well, and quantitative tightening and monetary tightening as well. He didn't really cover anything about consumer sentiment and the idea that people are just probably going to be spending less money on leisure in the future, and he pretty much just ignored the alternative investments out there, like Apple just being so much better priced for actually better businesses. Now, I really don't have much of a problem with his video. He's free to invest as he likes, and I do watch lots of his videos and I enjoy them anyway. The problem with that video though is that he didn't really speak about why the stock actually fell or why he thinks it's now priced appropriately or it used to be priced appropriately. He just ranted and tried to pretend that the news that we saw was good and that the market is just being irrational and dipping for no reason. If you look at the comments of that video, his viewers seem to get it where he doesn't. The biggest comments with the most upvotes are just saying that the company is priced for perfection, that it has no room for errors and it just saw an error. And on top of that, it's actually predicting more errors for itself in the future as well. Now look, if you love the company, if you think it's a great buy, great, go out and buy more. Lower your average cost and enjoy your investing. If it really is a high conviction stock of yours, then you should be happy to see it decrease in price, especially on news that you might consider good. Personally, I'm not going to be buying it. I'm not even close to buying it. I think it's just an overvalued company. It's a great business, but price action matters, and that's one of the most important factors when it comes to investing. Any company is a good buy at a certain price, and any company is an awful buy at a certain price as well. Of course, I'm bearish on the stock's price, but I did think I should show you at least a little bit of a bull case just to let you get the other side of the coin. Again, if you want to watch his whole video, it's about 10 minutes. It's a bit like this. It's just him talking at the camera, unscripted, I think. He's just explaining his point of view. It's an interesting video, if nothing else. Now, if you like this video, then let me know and I'll make more like it. The next company to look at is Coinbase, who came a close second place on the poll on my Patreon. If you want to vote for these kind of videos, if you want to decide which companies I cover next, especially when there are dips like this, then a link to join the Patreon is down below. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.